The market is looking pretty bad once again. On Friday, we were all thinking, okay, the buyers came in and brought this red candle up a bit, which was a bullish sign, but now we saw another gap lower in the markets today. Bearish sign. So let's do our standard market review today and go over whether the market will continue to fall and whether this is the end of the major bull market we've just been seeing. First, a quote though from my favorite market wizard, Ed Seykota. And he's my favorite just because he's super weird. But he said the elements of good trading are number 1, cutting losses, 2, cutting losses, and 3, cutting losses. If you can follow these 3 rules, you may have a chance. And you guys know I absolutely agree. That is the most important part of investing, and that's why I rant about risk control in every video and why I'm about to do it again. Because I told you guys, with a market like this, the way it's been going up, no one cares about risk control. No one cares about anything because everyone just seems like a genius. I put my money in and it goes up, which is great. I mean, for everyone, I'm happy for everybody. But the downside, like I talked about before, is that people forget that the market could turn around like it did right here. Even though we just had that huge crash right here. We got short-term memories. So if you get used to this beautiful up day every single day thanks to Master Powell, well then you might forget about risk control, which is really what's going to give you that success over the long term. So I'm looking at the NASDAQ right now, right? And it has dropped almost 10%, more if you count it to the lows. So yeah, this might be one of those buy the dip scenarios where the market turns around right away, but it may also not be one of those scenarios and we may see a sustained move lower. The thing is, nobody knows. And what you need to guard against is that sustained move lower if this thing doesn't turn around. And when you do it properly, you could get something like this. And I've showed you guys this chart before, but this was back in March during that huge crash, the CCPV crash. This is my equity curve right here in the green of my personal portfolio. And this is the NASDAQ. You see how mine went flat when the NASDAQ went down? Well, that's important because when the stocks turned around, I was already up here. I never went below 0. So when I was making gains again, it was on top of the gains that I had already kept during that crash. And that's the importance of risk control. That's how you really build your wealth year after year, because you protect it while everyone else is losing because the market is dropping. But of course, if this thing does rebound, then you feel like an idiot because you're like, oh, why did I even sell? I should have held on and I would have had more money. But again, that's not the way to think of things because you don't know. An example I was talking about in the last video was DocuSign. Our system got into DocuSign on the 1st, and you can see it rocketed up that day. And by the way, the system that I'm talking about that I use and most of our Fallible members use as well, we go over it in this free training. If you haven't taken it already, there's a link in this video and down below in the description and comments. It teaches you the exact strategy we use so you can use it yourself. Definitely worth your time taking it, especially if you agree with me on this risk control bit that I'm talking about, because that's what this strategy really focuses on. And this DocuSign is an example of what we just went through with that system. So again, we got it on the 1st and the thing rocketed higher. So on the 2nd, we already hit our first target. And at our first target, which is 20% above where we entered, we sell 25% of our position, which is another risk management technique to take profits off the table. And when we do that, when we hit our first target, we also pull our stop up to break even. So the model got in right here at 241, shot up, we took profits around here, 287 or something. And then what happened the next day? The stock collapsed, went back to our entry point, but because we pulled our stops up, we got out of it. So we had a small profit and cut off our loss. That's all risk control. And I was saying at the time, I mean, we didn't know exactly whether DocuSign was going to continue falling or if it was just going to rebound and make us look stupid. But my point was that it didn't matter because we're following the risk control. And sure enough, DocuSign has continued to fall. Will it rebound on its 50-day moving average right here? Maybe, maybe not. Either way, we could say that we were successful because we protected our downside and we followed the system. My bet, if the market keeps going lower like this, no, DocuSign is not going to bounce. But anyway, you can learn more about everything we're doing in this training. Check it out. Moving on, you can see that we are in some really crazy markets right now, like euphoric markets. So this is Citibank's proprietary positioning and sentiment model, and it shows the market is giving us its best effort to imitate 1999. Here's 99 right here, peak euphoria, especially in these tech stocks. And here we are approaching those same highs. And we all know what happened, right? After that peak euphoria, we crashed hard. Lots of people lost almost all their money. It was sad. Should I say risk control one more time? Yeah, I'll say it. Risk control. And hopefully you guys don't get too annoyed, but I do see comments sometimes saying, oh, thank you, AK, for reminding me. And I'm cool with that. I could be a broken record, no problem. I am a broken record most of the time anyway. This chart from BCA Research shows how crazy this run in big tech stocks has been. At this point, it's reaching those 2000 NASDAQ 100 peak insanity levels. So this graphs a bunch of trends over the years: Disney, gold, Japanese banks, NASDAQ in 2000, tech stocks, iron ore, and now we got our FANG plus Microsoft stocks index, which is, once again, hitting those highs. Now, when you see things like this doesn't mean that the market is going to crash tomorrow. Like, this could just be a minor correction, which we'll talk about in a second. But when you see this data, you also know that, hey, we are extended. We are a bit euphoric here. Now, it's funny that I say euphoric, and it's actually might be a little improper, because you got guys like Bank of America publishing reports outlining how pessimistic we all are. There's systemic pessimism that's pervading nearly all aspects of our society. So it's weird because the price action in the market looks euphoric, but people are still all around bearish. So this chart is the last 200 years of banking crises, and this is around the world. So you can see in the last 40 years or so, there has been a huge spike. And why is this spike so much bigger than the time period before? Well, that's because of leverage. It's the long-term Dalio debt cycles that we're talking about here. The more leverage that you have in the system, the more frail everything is, and the more crises you're going to get. This is what happens with all the financial engineering and innovation. But as you can see here, the Great Depression had the biggest spike during this time period, and after that there were relatively few for a number of years. Well, what happened was the big reset, which is part of the long-term debt cycle as well. So if we look what might happen now, we might have to go through that great reset, and then we'll have a quiet period once again. And speaking of pessimism, these two graphs right here are charting the tone of news. This one is the New York Times over here, and then the World News over here. And basically what it's saying is that the tone of news is getting more and more bearish. It's more bearish now than it was in the depth of World War II. So the question is that news really feeding this pessimism? Or is the news catering to what people want to hear? We're near all-time lows with the portion of population satisfied with the US. So how many citizens are happy with our country? So is the news just catering to that, or is the news causing that? Because all we see is terrible stuff all day. Now, my theory of this pessimism, and you don't need this chart to tell you that people just love crapping all over the US right now, especially our own citizens. My theory, though, is that part of that comes from how fragmented we've become. And I'm talking about things like the internet. Everyone can find their own tiny little group to sit in nowadays, which is a good thing because everyone's interests are met, but it also means that there's a lot of tiny little groups that I don't think we had before. So there's not much unity. And without that unity, yeah, one of the more popular things that might happen is a person talking down on their own country, saying it's horrible, when in fact, all these people don't know how good they have it compared to some other countries. And I get this the most when I start talking about China and the CCP, because the first reaction from so many people is like, hey, AK, what about the US? It sucks here. And I'm thinking, okay, yeah, the US government is not perfect. Our system, capitalism, everything, nowhere near perfect. But I'm confident in saying that it's better than what's going on in China with the CCP. It's like, yeah, we have systemic racism that we need to fix here, but it's better than being over there where you'll be put into a camp and have your organs harvested, depending on, what religion you are. And if you think they treat people of color better in China, the answer is no. And even without comparing the two directly, or us with any other country, you got to remember that there's a reason why US culture is everywhere. It's because there's some fundamental belief here in freedom and capitalism and working hard and getting what you deserve from working hard. Might not always work out like that, but the ideology that we have here is really important. And that's something that you do want to preserve even as you try to fix problems in your country. Identify them and fix them, but you don't have to be super pessimistic, thinking the grass is greener somewhere else. And that's my patriotic speech for you today. Here's another interesting stat. The percentage of Americans who own equities has fallen from 63 to 55% since 2004. And according to the Bank of America, this is once again pessimistic behavior, not risk-seeking. Now, there is a demographic component to this because there's a bunch of baby boomers who are retiring. And because of that, they're going to switch over to bonds instead of stocks. That's what you do. So you have less risk so you can preserve your capital. But with negative real yields, those preferences are probably going to shift back into stocks again. So it'll be interesting to see how this changes. Another crazy stat is that central banks have bought $1.4 billion worth of financial assets every hour, and the market cap of the NASDAQ 100 has gone up $1.6 billion every hour. How interesting. I wonder where all this money is flowing. The S&P was also very close to having the greatest rally of all time. It just needs to cross that 3,630 level to do it. Now, I'm not entirely sure what would kill that record, but I think it's probably a bear market, or the technical definition of a bear market, which is what, 10%? So it might still be in the running. We're technically only down 6% in the S&P. But then we have that question again, is this a short-term correction or something more long-term? Well, if you switch to the monthly chart of the S&P, you could see the last candle that we had, which is the August candle. You can see it closed really strong, big solid green candle, and this puts the odds in favor of us closing higher into the end of the year. And the reason we look at these monthly candles is because they have the least amount of noise. Where the market closes at the end of each month is kind of important, and it's easier to see the trend this way too. Now, if you look at the big picture of the S&P, you can see it's in this really large holding pattern, and right now we're brushing up against the top, which is a resistance. But if we're getting these strong monthly closes, then the likelihood of breaking above this holding pattern becomes much higher. So if we're looking at things long term, the bull market is still intact and it looks okay. But over the short term, things are a little different. If we look at sentiment and positioning, the narrative that the Fed is going to keep printing money and never let the market fall is now consensus. Everybody thinks that. All the surveys, the bull bear surveys, are at multi-year highs. Everyone's super bullish, and speculative call buying is at record highs. So sentiment and positioning have become major headwinds and a source of trend fragility. And remember, sentiment and positioning, they're like contraindicators. So if people are super bullish and euphoric, that's a bad sign for the market. You want people more pessimistic and bearish. Same thing with positioning. If everybody's positioned long, then where's the only way the money is going to flow? It's got to flow out of the market. So if you have bullishness and strong positioning, that's not good, at least in the short term. Now, if we look at the breadth of the market, which is how many stocks are going up versus down, that's weakening as well. And it's setting up for a near-term top and a 10 to 20% retrace in the coming weeks. Macro conditions are rebounding and liquidity is flush, but yields are starting to rise too. And credit spreads are diverging from stocks. Normally those two go together. So this divergence again will likely lead to a near-term top in the coming weeks. So looking at the markets, even though the overall bull market should be intact, it's not out of the question that we get a 10 to 20% retrace here, which especially wouldn't be surprising given how crazy this market has been. It's just gone straight up. So something's got to give, right? But once again, you don't know for sure when something's going to be a dip or is it going to be a serious crash. You got to play it as it's happening. And that's once again exactly where risk control comes in. You need your stops in place, you need your targets in place, and then you need to execute on those things. And the executing is a whole nother story because you need to get your psychology in place. So again, we talk about all of that in this free training and how to put it all together and how to trade it and how to protect yourself, especially in this volatility. If you want to check that out, there's a link in this video and down below in the description and comments. Definitely do that now. Don't wait. Get your protection in place. If you like this video, make sure you subscribe because we'll keep updating you on what's going on with the market. Do that and we'll see you in the next video. Stay fallible out there. Bye.